let me go over some announcements I made in email. First, I've posted a video on Monopoly. That sort of corresponds with last Tuesday and a little bit of Thursday, I believe. Then I have some notes right now on monopolistic competition, just some things I've written on the most important highlights of monopolistic competition. But let's see. I'll try to prepare a full video for that. Okay, important thing though is that I've extended the time period during which you can take the exam. So anytime between Tuesday morning and Saturday night. Got it? Okay. Give you all a little bit more flexibility, as well as the people who aren't able to attend. Give them a little bit more flexibility in the timing of the test. And the final thing I'll mention is you have this writing on a current event in economics. Again, search through current news articles, news journals, newspapers within the past year or so. Find a topic, and this is a little bit like a book report in that you summarize, but then also add your own analysis and tie it to what we've talked about in this class. Okay? So for example, last week in one newspaper I read an opinion piece that talked about wearing masks and that we essentially have an obligation, that people talk about wearing masks as a matter of personal freedom, but really exhaling contaminated breath is a matter of air pollution. And the government has a fairly well-established role in regulating pollution, right? So this is all about externalities and regulating externalities. But it points out this, very literally, if you're exhaling infectious breath, you're causing air pollution. And again, government seems to have a role in regulating air pollution. Okay, so that's something where you could find the piece, you take a piece like that, summarize it, and provide some analysis that connects it to this class. All right, sound good? I think officially that's due Monday night. If you want some flexibility, let me know. All right, so at this point, let me start talking about a new topic. Today, I want to talk about insurance. And I'm changing the topic from what came next in the textbook. The next topic in the textbook was oligopoly, which is competition between a couple of firms. And it's a useful topic, but to be honest, if there's one market that's really interesting, it's the market for insurance. And it's also important for you all to understand this because, number one, you're going to be buying insurance in your life. Number two, it comes up as a matter of policy continuously throughout my whole life. I've watched presidential debates going back to the time when I was a little tiny baby, and politicians on TV were still talking about, should we have kind of national health care? That's 40 plus years ago. Politicians were talking about the same thing they talk about in debates today. So it's an important topic, like health insurance especially is an important topic. So I want to talk about some of these things and help you all understand why it's not easy. There's no easy solution to the issue of health care. And I will say things that might support different perspectives, but I have no absolute opinion on this. I'm not going to say that one system is clearly the winner. Okay, so insurance. First thing is why? Why do we have insurance? And the answer is really consumption smoothing. Okay. So consumption smoothing, we like to have a reliable flow of of consumption, or maybe think of it as reliable flow of income, rather than to have a lot of variation. So if you were to ask people to choose between two options, option number one, the person has a 10% risk of losing $10,000, 90% risk of losing nothing, or option number two is lose $1,000 for certain. The answer to that question is really a matter of preference, but most people, almost all people, will select option number two. They would rather get a certain small loss than a chance of a big loss. And, okay, so again, the real answer is a matter of preference, but almost everyone seems to prefer to take a chance of a small option. This is, by the way, more or less how your car insurance works. I mean, you might purchase car insurance against the possibility that you're in a collision and you lose your car that's worth $10,000. It's totaled. So if you have no insurance, you lose $10,000 of a car. Alternatively, you can purchase insurance that will cost you $1,000 a year, but then if you lose your car, it replaces it. And again, most people seem to opt for the certain loss of a small amount over a risk of losing a large amount. Now, by the way, notice that these two options I've presented have the same average value or same expected value. Right? So neither of these is like more money on average. I've presented two alternatives that have the same average value. Okay, now, how does insurance work? The answer is risk pooling. Okay, risk pooling is getting a group of people together and knowing that each of them has a small chance of an accident, but when you aggregate them or add them together, you know pretty reliably what the loss will be for the group. Okay, so imagine instead of just you're in this on your own, you're part of a group of 10 people, and you each face option number one, right? You each have a 10% chance of having a large loss during the next year. Everyone in your group could agree that at the start of the year, you're each going to contribute $1,000. You're each going to pay $1,000 to some fund, some insurance fund for your group. And then whoever experiences the loss, the money covers that, right? So that's a matter of 10 people getting together, and they agree that they're all going to pay the same amount in the beginning, and they will cover whoever has the loss. That's more or less how insurance got started, by the way, especially in the U.S., life insurance, for example, started with fraternal organizations like Moose Lodges or Elk Lodges or Knights of Columbus or Masons. These organizations would provide health insurance to their members, and everyone would pay some fee at the start of a year. And then if anyone died, the organization would pay the family. Okay, so it was like a very simple version of a group of people get together, they each agree to pay to a common fund, and then that fund is used to compensate any family that experiences a loss. Okay, so, risk pooling works better the larger the group is. So I brought up, like, you and 9 other people could get together in this experiment, and each of you puts $1,000 into that account that's going to cover your losses. Now, odds are, most likely, one person in the group will experience a loss. But there is some chance that 2 people could experience a loss, or even 3. So, even though on average 10% of people experience a loss, in a small group it could be 20% or 30%, which is a problem for a small group. But if you expand the number of people in this pool, if you have 100 people working together, it's very unlikely that 20% of the group will have losses. The odds of that happening in a group that size are tiny, tiny. The odds of 30% of the group having a loss are extremely tiny. The larger the group is, the closer the percent who have a loss, the closer that'll be to 10%. This is something called the law of averages. So as the group gets large enough, they can pretty reliably count on this system to working. This system will work. Now, by the way, what I'm describing here, these 2, like making a payment of $1,000 in exchange for getting rid of this risk, if that were insurance and the 2 things have the same expected value, it would be described as actuarially fair. Actuarially fair. Insurance means that the cost is equal to the expected benefit. Okay, now, as a matter of fact, most people will buy insurance even when it is not actuarially fair. In other words, most people would pay even, say, $1,100 to a company that agrees it's going to pay off the $10,000 in case they experience that loss. So most people are willing to pay even a little bit more than what's actuarially fair in order to have this consumption smoothing. And we like consumption smoothing for a couple of reasons. I should mention why these are. Oh man, I love all these different colors. It's so easy to swap out. Reasons why we like consumption smoothing also include risk aversion. Okay, we just don't like risk. Most of us don't like risk. We would prefer to have certainty over randomness. And it's just nice to be able to plan your budget for the next year, knowing that you're going to pay $1,000 for insurance, and that's a done deal, and you don't have to worry about some chance that you're going to get hit with a large bill and you have to suddenly adjust what you're spending your money on. So most of us don't like risk, and we'd prefer to do away with it. The second is liquidity constraints, or being liquidity constrained, which is a fancy term for just simply don't have the cash. If you were to wreck your car and need to buy a new one, so like a $10,000 loss, you might not have access to that much money. And that's what we call liquidity constrained is the technical term. Liquidity means easy access to cash. And so economists will talk about liquid assets. That does not refer to beer. A liquid asset is one that can very easily be turned into cash. A house is not a liquid asset. A car is not a liquid asset. So anyhow, liquidity refers to being able to get cash. Some people are constrained. Okay. So anyhow, moving on. Moving on. New slide. Let me introduce you all to a handful of vocabulary words that relate to insurance. First, a premium. Okay. The premium is the certain payment you make for the insurance which covers, and the insurance covers the cost or covers the loss that you might experience. Okay, so it's what you pay to subscribe to the insurance policy. You all are probably, if anything, you're most familiar with your car insurance, I expect. And every month or every few months or every year, you get a bill from your car insurance company saying that you need to pay $1,000 to have insurance coverage for the next year. That $1,000 is your premium. It's the payment you make for the insurance, okay? The cost of the insurance. A second term is a deductible. Okay. Many insurance policies will have a deductible, and this is a portion of the loss that is not reimbursed. Okay, so your car insurance policy, if it covers damage to your car, you might have a deductible of $200 or $400 or $800, which means that you will not be reimbursed for that amount of damage. If you have a $200 deductible and you're in an accident that causes $3,000 of damage to your car, you pay $2,000 to repair the damage, and your insurance company gives you the other $2,800. But you're responsible for that deductible. Deductibles are also common in healthcare. So I think my health insurance policy has something like a $3,000 deductible for certain types of treatment, especially emergency care and hospitalization, which means that if I go to the hospital, I'm required to pay the first $3,000 of my costs, and then after that, the insurance policy pays the bill. Okay? So deductible is a portion that the customer pays, and it's not reimbursed. Another thing that comes up, and I think this is only with health insurance, is a copayment. I don't know of any type of insurance that aside from healthcare, that has a copayment. This is a portion of the cost of some services that is paid by the consumer. In other words, not the insurance company. And in my health insurance or my health care plan, there is, for example, a $30 copayment for seeing my doctor. So whatever the cost of the doctor's visit is, my insurance company pays for it, except for $30 that I'm responsible for. Okay? It is similar to, but different from a deductible. And most healthcare services will have either a copayment or a deductible. But again, it's complicated, and I'm sorry that it is so complicated. It just is. Okay. Now, I want to talk about health insurance or health specifically because there's something weird about what we think of as health insurance. Health insurance, let me put some quote marks around the word insurance because it's not entirely insurance. Really combines two different products. One is, what did I just do? Okay. One is maintenance. And this is for routine. This is really referring to routine, anticipated, smaller costs or small expenses. Okay. So some of the health care I receive is fairly predictable and small. So like every month I go see my shrink and we talk about all my issues. And my shrink prescribes me some pills that I take every day. Okay, those things are all very routine for me. Okay? The other product that we get from health insurance is for catastrophic events. Go away. No, come back. Catastrophic care. And this is for major expenses that are unanticipated. Okay, so that's catastrophic care. That's like if I'm in a car wreck, the cost of being transported in the ambulance and checked out in the emergency department and receiving some treatment, those are expensive. That adds up to several $1,000s, and it's not something that we could have anticipated. It's fairly random. Or if I get diagnosed with cancer, that's likely to be something very expensive and, again, not anticipated. It's not a routine matter. Okay, do you get the distinction between these two types of health care? Let me talk about an analogy with cars. Your car needs to be repaired for a couple kinds of things. One is that you can fairly reliably anticipate that you're going to need a new set of brake pads every 40,000 miles. And you'll probably need tires every 60,000 miles. And you've got oil changes at certain intervals. You can anticipate that wear and tear pretty reliably, more or less. And those are repairs that happen, and you don't expect your car insurance to cover those costs. Now, sometimes when you buy a car, actually, a dealership might offer you a maintenance plan that does, in fact, cover some of those things for the first couple of years, like tire rotations and oil changes and those other anticipated things during the first few years. It might be called a maintenance plan, and it comes from the car dealership. Now, if you get that kind of maintenance plan, it's not going to cover accidental damage. If you hit a pothole and blow out a tire, the maintenance plan isn't going to cover that. So the maintenance plan from your car dealership covers the really anticipated and routine things, but not the unexpected major things. Now, the other type of insurance might be what you purchase from your car insurance company, what you really think of as insurance, which covers the major collisions that are things, and that's something that you don't anticipate, but it is going to be expensive, right? That's really why you buy car insurance, is to protect against those catastrophic events, is the term I use, okay? Again, major expenses that are unanticipated. That's what your car insurance covers. Now, health care, the health care policy you have really provides both of these to you. Like your car insurance company doesn't pay for replacing your brake pads when they wear out. It just pays for the unanticipated major costs. But your health insurance does pay for the routine maintenance and the routine anticipated doctor's visits. It also pays for the catastrophic things. But what I'd like to emphasize is conceptually, these are two different products that get combined together into something that we think of as health insurance. Does that make sense? That's part of why health insurance and healthcare is so complicated, is because we're really blurring or blending together two things that are different. Okay. So, maintenance, catastrophic. Okay. Let me introduce a handful of other models of healthcare. Different ways of providing health care in a country. The first is the private market with private insurance. Okay. There's really only one country in the world one major developed country in the world that relies on this model primarily. That's the good old US of A, where everything is, in principle, all healthcare is private. Your healthcare is provided to you by a private company, a hospital or some medical facility, and the healthcare providers, the doctors and nurses and technicians, are all they're all employees of private companies. In other words, they don't work for the government. They don't receive their money from the government. They receive money from you, the customer. Though really, in most cases, through your insurance company. But the government is not involved in this. That's the US model, is that, again, in principle, hypothetically, it's just transactions between private customers and private businesses. Okay. I will say, however, other countries do have even countries that have national health care might also have private markets for additional health care. If people want to purchase more health care than the government might provide, there might be a private market still for health care. Okay, so that was one model of health care. A second model is a single payer system. Where the health care is provided by private companies and private employees. okay, but paid by the government. And our neighbors to the north in Canada use this type of system. The hospitals are privately owned. The doctors work for, the doctors are simply employees of these private businesses. They don't work directly for the government. However, the cost of medical care is paid by the government. So when the doctor does surgery, the government mails the check to the surgeon, okay? But the surgeon still works as a private employee of a private business. So that's the single payer system. Now the US does kind of have some versions of single payer systems, Medicare and Medicaid. Medicare is for old people, Medicaid is for poor people, and the government pays for their health care. And the doctors providing the care are still private employees of private businesses, just the government pays the cost for them. That is, again, more or less the system in Canada. And over the past year, you've heard at least a couple of politicians talk about the idea of Medicare for all. That is essentially a single payer system for the US, where Medicare for all is the idea that we do away with insurance companies, and instead, if you go to, we do away with the insurance companies, but we keep the hospitals and doctors the same. Whenever you need care, you go to your doctor, and instead of your insurance company and you sending payments to your doctor, the government sends the payments to your doctor. So the government pays the cost of the health care. Now, presumably, the way this would be implemented is by taxing people, but in principle, that tax is balanced by doing away with health insurance premiums that people pay. So, like, again, instead of people paying health insurance premiums, to have a health insurance company pay for the cost of their medical care, they would pay taxes to the government to pay the cost of their medical care. That's the idea of a single payer system. And Medicare and Medicaid are examples of essentially single payer type systems for those groups of people. And okay, now a third model is nationalized and I'll even use the term socialized health care. Socialized health care is, the term socialized has a very negative stigma to it. But by the way, if you listen to the presidential debate last Thursday, you heard this term come up, right? President Trump kept saying that Biden wants to have socialized medicine. What exactly does that mean? Socialized medicine or nationalized medicine means that the government owns the healthcare facilities. Healthcare facilities and healthcare workers are government employees. Think of the way that public schools operate. That's essentially the idea of a socialized business. The local government owns the school buildings, owns the stuff inside the buildings, and the teachers at the public school are employees of the usually town, city, or county government. Okay, that's more or less the model. Or another example of a socialized business is the Postal Service. Postal Service buildings, vehicles are all owned by the government, and people who work in the Postal Service are government employees. Okay, the model for nationalized healthcare would be that all the hospitals are owned by the government, just as post offices are owned by the government, or schools are owned by the school district. And the doctors and other healthcare workers are government employees, just as like mail carriers are government employees, or public school teachers are government employees. That's this model of nationalized healthcare. And, okay, examples. Britain uses this model for providing health care. But also, the US does have an example of this, which is the Veterans Administration. VA hospitals are government-owned hospitals, and the healthcare providers who work for the VA system are all government employees. So if we were to talk about, if a politician talks about moving to nationalized health care, that means providing health care more or less in the way that the VA provides health care to veterans. Government-owned hospitals, and the government directly employs the healthcare workers. Okay, so these are really the three models of public health care that are used around the world. And the US, again, has this system with essentially private markets, or theoretically private markets. Okay, so we've talked about insurance in general. I've given some definitions. I've talked about the complexity of health care. Now, I want to talk about why why insurance markets are so bizarre. There are two types of market failures. In the insurance market. Okay, remember, a market failure is a reason why the market doesn't work efficiently. And I don't mean to say health insurance specifically. All insurance has two fundamental problems that make the market difficult to function successfully. The first problem is called moral hazard. And please, keep this idea in mind. Like, carry this with you for the rest of your life, at least if you're thinking of insurance-related things. Moral hazard is an important idea. This is that having insurance changes behavior. Okay, that's it. Okay? And typically, insurance causes riskier behavior, which is more expensive losses, which drives up the cost. And drives up premiums. So, again, moral hazard refers to the fact that knowing you have insurance changes your behavior. And you might not be as careful. If you have insurance, you might not be as careful as you would have been without insurance. think about driving. If your car is not insured and you get into an accident, you are responsible for the cost of that accident. If you have insurance, get in an accident, you don't pay the cost of it. So this clearly being uninsured provides an incentive to be a safe driver. Yeah? And having insurance removes that incentive. Or if you have health insurance, you might not be as careful to have healthy habits because you know that, if you eat too much bacon and your arteries get clogged, well, your health insurance will cover the cost of cleaning out your arteries. Okay? That's moral hazard. Having insurance changes your behavior. I can even take this to extremes. Like, I love to tell a story about this old Subaru Outback that I once had, and I hated it. It had serious engine problems, and I knew I couldn't sell it because if any mechanic checked it out, the mechanic would immediately identify that there are obvious problems with this car, and it wasn't worth anything more than scrap. So I just kept hoping that one night I'd be driving home on a country road and Bambi would run out in front of the car. If that happened, I was not going to brake. I was going straight into Bambi. I was going to total the car for the insurance money. Okay? That's moral hazard. Having insurance changed my behavior. That's the extreme version of moral hazard. I hope you all get this, right? So having insurance changes the way that people drive and can make them riskier drivers, which results in more accidents, which results in higher costs of providing insurance, which results in more accidents mean the cost to the insurance company is higher, which translates into higher premiums for customers. With health insurance, I brought up the issue of changes in behavior, and people might behave in riskier ways. Even simpler than that, an example of moral hazard might be that the whole copayment system messes up cost-benefit analysis. Here's what I mean. Imagine that a visit to the doctor requires $100 of resources, and my doctor might charge $100 for a visit. That covers her time and the materials that she uses. Okay, I wake up one morning and I'm feeling kind of sick, and I know I could go to my doctor and get cured. Okay, how much is that cure worth to me? I think about it. It would be worth $50 to feel better. Now, if we think about this from a social perspective, is it worth using up $100 worth of time and resources to bring me $50 of happiness? No. Okay? So the efficient decision is don't get treated for something that minor. And if I had to pay for my medical care out of pocket, that means I have to pay all the costs myself, I would reach the same conclusion. My doctor charges me $100, and it provides me $50 of benefit. Therefore, I should not do it. Okay, it's a large cost for a moderate benefit. But the way my health insurance works is I pay only $30 of a doctor's visit. I have a $30 copayment, and then my insurance company pays the rest of it. So that changes my calculations. If I go to the doctor, I get $50 of benefit from being cured, and I myself pay $30 for it. So then it's worthwhile for me personally, it's worth going to the doctor. So I go to the doctor even though it's an inefficient use of society's resources. Okay? The lower the copayment is, the more inefficient my behavior would be. Heck, lower the copayment to $2, and I would go to the doctor every time I get a little scrape. I'd go to her so she can clean it out and put on a professional bandage. And it might take up $100 of resources to do that, but I pay only $2 of it. So I hope you understand how the whole copayment system changes the cost-benefit analysis for people and leads to what I would call overutilization. Well, what an economist would call overutilization of healthcare. The only way to avoid that is to have the patient pay all of the cost of their own treatment. If the patient has any say in whether to be treated, the patient, to make a correct cost-benefit analysis, the patient has to pay 100% of the cost. If the patient pays anything less, then decisions will be inefficient. Okay? So co-payments at least try to restore or try to create some cost-benefit analysis for the customer. Try to force the customer to do at least some cost-benefit comparisons. If all healthcare were automatically completely paid for by the health insurance company, then I would get treated for even the most minor things, and that would be very wasteful. So having the patient or the customer pay a portion of the healthcare gives the patient some incentive to think about that cost versus benefit. Okay, now, again, I describe this problem, this moral hazard problem, as overutilization of healthcare. My wife and I argue about that. She's in public health, and she would probably call this better access to healthcare. And see, I'm recording this, and I'm really paranoid that this is going to go on the internet where she can hear this recording, and she'll be mad at me for saying that. We have different perspectives on this. Again, she thinks of healthcare in this way as improving people's access to healthcare that they would not have received otherwise. I see it as it causes people to get healthcare that would not be cost effective. Okay, but this is one of the problems with insurance, and I guess you all can understand how the fact that we don't pay the full cost of our insurance or our healthcare is inefficient, and then it leads to using healthcare more than we should. Okay, sorry, Kristen, if you're listening, but that's my perspective. Okay, using healthcare more than we should, and then that drives up the costs of healthcare. All right, so moral hazard, it exists in all insurance markets. I can tell lots of interesting examples. One example from the kidnapping and ransom industry. By the way, did you know there's a kidnapping and ransom industry and you can buy kidnapping and ransom insurance? It's fascinating stuff. The interesting thing I learned is that it's common in kidnapping and ransom insurance policies that the person covered by the policy cannot tell others about the policy. Okay, so kidnap and ransom insurance is not common in the US, but it exists in places like Mexico or Colombia. And see, the problem with kidnapping and ransom insurance is, imagine dad gets kidnapped and then the kidnappers call you and say, hey, let's talk about a ransom. If you know that this ransom is covered by insurance and the insurance company will reimburse you for the cost of dad's ransom, you're like, how much do you want? 100 million, 150 million? Sure, whatever, okay? We'll give you the money. Insurance will reimburse us, so just give dad back. there's no incentive to negotiate, right? And that's moral hazard. Having insurance changes your behavior. What the insurance company would really like to force the families to think about is, how much is dad really worth? Is he really worth $100 million? Of course not, okay? So how much is it really worth to this family to bring dad back? 3 million, 10 million? Decide what that is, and they need to act like they're playing with their own money. They need to decide for real, dad is worth $3 million, and here, we have put $3 million in a suitcase that we're going to take to the kidnappers. Like, that is a real commitment, that when they pay a real demonstration of what they believe dad is worth, when they take their own money to pay the ransom. Okay, and so if the family has made this cost-benefit analysis, decided what dad is worth, demonstrated that they are in fact willing to pay that amount for dad, after they deliver the money to the kidnappers and and dad is returned safely, then the insurance company says, surprise, this was all covered by insurance and we'll pay you back, okay? It's a really weird thing, except you understand the logic, right? The family needs to have an incentive to negotiate what dad is worth. And it's a strange way to think of things, but I'm an economist, and I do have this strange way of thinking about it. Everyone has a value to them. Everyone has a value to others. Kidnapping and ransom gets even more interesting. It turns out that, one thing you might wonder is, why do kidnappers even return dad after they get the money? And at least historically, in, again, Mexico and Colombia are the countries that I know, kidnappers value their reputations highly. So a kidnapper wants to make it clear that if you pay the ransom, they will return dad safely to you. Okay? So they take this seriously. And it's sort of funny that reputation is super important to them. Because you understand the problem. If you don't trust the kidnappers, if you think they're just going to kill dad no matter whether you pay the ransom, you're not going to pay a ransom. They get nothing from that. So it's in their best interest to have a good reputation. Okay, but I'm getting away from moral hazard, which was the initial topic here. Oh, another example, life insurance. Okay, life insurance policy is one that pays out when a person dies. It pays money to some beneficiaries, usually the family. So what's the moral hazard problem that could come up with life insurance? How can having life insurance change behavior? Stephen? It creates an extreme incentive to kill? Is that what you said? It's in a lot of movies. Absolutely, right? That's moral hazard. Just to give it a name, that's moral hazard. The existence of insurance changes behavior. Okay? Now, what we might think of more typically as moral hazard is more subtle than that. Maybe it's that I'm more cautious with what I do in my daily life if I'm not insured, because I know that it would be disastrous to my family to lose a primary earner. Okay? So I'm just more careful if I have no insurance. If I have life insurance, I might be willing to be riskier and do things like teach in classrooms during a pandemic, knowing that if I die, my family will get a bucket load of money. Okay? Again, that's what we more typically think of as moral hazard. But the extreme version is, yes, killing a person for the insurance money. Burning down your house for insurance money. That's also moral hazard. Okay, so you all probably get all of this. The other type The other type of market failure is called adverse selection. Adverse, that word means bad, more or less. Adverse selection is that the types of people who want to purchase insurance are the worst types of customers to have. Adverse selection, to give it a definition, the customers who want to purchase insurance want to purchase what? Tap here to go away. I don't know what that box there is. Please ignore it. Types of customers who want to purchase insurance are the ones most likely to anticipate having high costs. Okay, and they are the worst types of people for the insurance company to insure. So let me create a hypothetical market. There are 4 people. Let's see. Okay, Ann, Bob, Carl, Dan, and they anticipate that their losses during the next year will be $1,000, $2,000, $3,000, $4,000. What types of losses? This could be health care. This is what they anticipate spending on health care. Or it could be car insurance, or it could be any type of insurance, really. But maybe this is health insurance, and Anne knows that she's young and healthy, and she will have fairly low costs during the next year. Dan is getting up there in years, and he's got some conditions, and he anticipates that he's going to need some expensive care. Or maybe we're talking about car insurance, and Anne knows that she's a safe driver. She rarely has accidents, and when she does have one, it's not too bad. Dan, on the other hand, Dan knows that he's a speed demon, and he likes to text while drinking and driving. Dan knows that he's likely to have expensive insurance costs. Okay, so the people know they have different costs. Now, the insurance company might try to design a policy to cover everyone. This is especially a problem. Like, adverse selection is especially a problem when the insurance company doesn't know who are the expensive people and who are not expensive. An insurance company would offer a policy, in this case, an actuarially fair policy would have a premium of $2,500. That's the average cost or the average loss for one of these people. And then the insurance company covers the cost of their loss. So again, that's what would be actuarially fair. There's no profit on average for the insurance company from that. And same for the people. On average, they get out what they pay in. The problem is if people can choose whether to purchase this insurance, the people who anticipate low costs will choose not to purchase insurance. So each of these people might have a choice to pay for their losses out of pocket. So that means they don't use insurance, they pay for it themselves out of pocket, or they can purchase the insurance and then the insurance company covers their costs. If all of these people think simply about the money or the monetary aspect of insurance, and could pay $1,000 out of pocket or purchase health insurance or insurance that costs $2,500, Anne is better off just paying out of pocket. So she would not buy the health insurance. Same thing for Bob. Bob anticipates that if he just goes on his own, no insurance, he would have to pay about $2,000 for health care or to repair his car. Alternatively, if he purchases insurance, it would cost him $2,500. So Bob is also going to decide not to purchase insurance. Okay, but insurance is a good deal for Carl. You know, if he pays out of pocket, he'd pay about $3,000. Alternatively, if he purchases insurance for $2,500, they'll take care of all his losses. And it's a good deal for Dan, even better for Dan. Without insurance, he pays $4,000 out of pocket. With insurance, he pays $2,500. So the two people who purchase insurance are Carl and Dan. Okay, but not Anne and Bob. So the people who purchase the insurance are people who anticipate having high costs in the future. And they are the worst type of customers for the insurance company. In this case, the average, if the premium is set at $2,500, the average cost is $3,500. $3,500, right? That's the cost of covering Dan and Carl. So the insurance company loses money. Maybe I shouldn't say loses money. Negative profit. Okay, that's a bad thing. It's a weird paradox, almost, that people who would want to purchase insurance at any price, the insurance company shouldn't want to provide insurance to anyone who would want to purchase it. Yeah, it's, like Carl and Dan would want to purchase insurance at a cost of $2,500. They are the ones the insurance company does not want to cover. Now, okay, so if the premium were $2,500, then the insurance company would be losing money. And so they'd have to bump up this premium. And so then raise the premium to $3,500, which is the average cost of insuring Carl and Dan. But now the people think about this again. If the insurance policy costs $3,500, now Carl changes his mind. Carl's better off just paying out of pocket. And $3,000 out of pocket instead of purchasing the health insurance for $3,500. And the only person left purchasing health insurance is Dan. And again, this is negative profit for the insurance company. They're charging $3,500 for insurance, but the only person who purchases it is Dan, and it's going to cost $4,000 to cover Dan's health care. So again, the insurance company has to raise the premium yet again. And now in this case, let's raise it to $4,000, which is the cost of covering Dan. And Dan's okay with that. Dan will purchase it, and the company is now no longer losing money. But, and I guess I would call this maybe the equilibrium in the market. Like, there's no pressure for the market to change from this point. Health insurance costs $4,000, and the only people who purchase it are the people who are going to have $4,000 of expenses. Okay? It's really not a good outcome because none of the other people can afford health insurance. Ann, Bob, Carl are all priced out of the market. Okay, but do you see how these premiums keep going up and up? And I bet if you listen to political commercials or politicians talking, they will complain about health care premiums spiraling out of control. Well, there is some truth to that. You see how they keep escalating because at any price, any premium, the only people who would want to purchase the policy are people who anticipate having higher costs. And so when only the expensive, you get how this works, I think, right? Okay. So again, this is the problem of adverse selection, and it's a problem in any insurance market, in healthcare as well as car insurance. Or homeowners insurance is another important insurance policy. Primarily, homeowners insurance covers damage to houses. So think of things like fires and natural disasters. There's some people who just really, really need to have homeowners insurance. I mean, for example, what types of people just really you'd be crazy not to have home insurance if you had, or you lived
near somewhere where there are like hurricanes.
Near somewhere where there are hurricanes. Like the Outer Banks of North Carolina. Have y'all been to the Outer Banks? Beautiful beaches, okay. And these beautiful beach mansions, expensive things. You'd be crazy not to have insurance for your big fancy beach mansion if it's right there on the Outer Banks, built on sand, and hurricanes blow through a couple times a year. You'd be crazy not to have insurance. And an insurance company would be crazy to provide you with insurance. This is a problem for people who live in these high-cost areas, places that are prone to hurricane damage, are prone to flooding. So often if people live in an area called a floodplain, which is an area prone to flooding, usually close to a lake or a river, insurance companies will not cover the cost of their insurance. So what else? Again, adverse selection, those are the people who would most want to purchase homeowners insurance. So adverse selection really happens, or it's an issue, because of choice. Adverse selection would not happen if everyone is forced to purchase insurance. So that's a funny thing about insurance. It doesn't work well if we let people decide whether they want to buy insurance because of adverse selection. People will buy insurance only when they think they're going to need it. So to make this market work, we kind of have to remove the choice. So a couple of ways of doing this. One is if the is health insurance through employers kind of overcomes this problem. If employers provide insurance to all employees, the problem of adverse selection goes away. And the insurance would cost, like back in my example with Ann, Bob, Carl, and Dan, the average cost of insuring any of them would be $2,500. If the employer purchases an insurance policy that covers all four of them, the employer could purchase that policy at $2,500 per person. Like the insurance company would sell it at that price. The insurance company is not losing any money on it. So the employer could purchase a reasonably priced policy, but more or less on the condition that the employees don't have a choice in whether they are covered. And that allows the cost to be reasonable. This is an important reason, that feature has really shaped the way healthcare works in the US. Not healthcare, I'm sorry, health insurance. And this is in part why many people receive healthcare through their employer, and employers can provide healthcare policies or coverage at a reasonable cost. But if people go onto the private market and attempt to purchase a policy on their own, it's very expensive. That's because of this problem of adverse selection. Okay, another attempt was in the Affordable Care Act. Okay, Affordable Care Act, what is that more commonly known as? Obamacare, correct. And it had an individual mandate. Okay. Who knows what this individual mandate was? The Affordable Care Act, one thing that it did was it tried to require everyone to purchase health insurance. Make it a requirement for everyone to purchase health insurance. On the logic that if we require everyone to do it, it will bring down the cost of premiums and make health insurance affordable. Okay? It'll eliminate that problem of adverse selection. So there was a requirement in the Affordable Care Act that everyone must purchase health insurance. Now, it was kind of complicated because the government can't actually force people to purchase something. So instead, it was a large tax penalty that a person had to pay if they didn't purchase their own health insurance, or if they didn't have either coverage from their employer or privately purchased health insurance, they had to pay a large tax penalty. Was the way that this individual mandate was implemented. Got it? Okay, so it was an attempt to force everyone to purchase health care because that would solve the problem of adverse selection and allow the market to function better without premium costs spiraling out of control and no one being able to afford health insurance in the private market. Okay, I hope you all understand what that refers to, that individual mandate. Have you heard talk of the individual mandate in the past week or so? If you listen to the presidential debates, it came up often. President Trump has tried to remove the individual mandate from the Affordable Care Act, remove that requirement that people purchase insurance. And that might even be one of the things that's heading toward the Supreme Court right now. Okay? So it's a funny thing, but making it a requirement for health insurance, that people buy health insurance, is actually good for the market in general and for most people. Removing the element of choice allows the market to function better. Okay. So I hope that makes a little bit of sense. Insurance markets are funny. And again, they have these weird problems. Adverse selection, let's see. Insurance companies don't want to sell insurance to people who are going to need to use it. Let's go back to car insurance. Car insurance companies don't want to insure dangerous drivers, right? Sorry, let me pause for a second. The one thing that, let me back up and explain car insurance a little bit more. Okay. There are a couple of different types of car insurance. One is liability insurance. This is for damage to others. Okay. And for the most part, every driver is required to purchase liability insurance. Again, that covers the damage that I do to someone else's car if we're in an accident. Other types of insurance, and most important one is collision insurance, covers damage caused by me or nature to my car. Okay, so if I'm in a wreck and I'm at fault, I damage my own car, collision insurance will cover that cost. And usually collision insurance is optional for people who own their own vehicles. If you have a bank loan, the bank would almost certainly require you to have collision insurance. But collision insurance is expensive because there's a matter of choice in it. And I personally opt not to have collision insurance for my vehicles, because I believe I am generally a better than average driver, and I'm at lower risk of having an expensive accident. But on the other hand, if you're really accident prone, of course you want to have collision insurance. You want to purchase it. Well, this creates a problem for the insurance companies because they know that the people purchasing collision insurance are people who are generally accident prone. So that means collision insurance is very expensive. It's not expensive just because the cost is high, but also because the insurance company is making assumptions about the customer based on their desire to purchase insurance. That's part of why it's so expensive. You're sending a signal to the insurance company that you are accident prone when you purchase collision insurance. And so because of that, they charge you a high cost for the policy. So does that make sense? Right? And again, since I think I'm not that accident prone person, I don't want the insurance company to assume that I am by purchasing the collision insurance. Okay, now with car insurance, deductibles are a big deal. And a deductible is a portion of the loss that the customer pays. And when you purchase insurance, you might be given a choice: how much of a deductible do you want to have? And I think an insurance company might offer $200 deductible or $400 or $1,000 deductible. And those are sort of plausible values for car insurance deductible. The lower you set your deductible, the more it signals that you are an accident-prone person, and the higher the insurance premiums are. So this is kind of a trick that insurance companies do to help identify who are the low-cost people, who are the medium-cost people, who are the high-cost people. A person who selects $1,000 deductible must really be sending a signal that, yes, in case there is a big accident, they want some assistance, but they are kind of betting their own money, their own $1,000, that they don't plan to have an accident, right? They've got something riding on this. They've got their own $1,000 that they would lose in case of an accident. And you would only agree to pay $1,000 deductible if you're fairly certain that you're not going to have an accident. Okay, so, again, these different deductibles are provided by the insurance company to help categorize people or to get people to self-select into people who are kind of betting a lot of money that they're not going to have an accident versus people who are willing to bet only $200 that they're not going to have an accident. Kind of approximately a way of thinking of this. Okay. So, again, that relates to the problem of adverse selection. I think I want to bring up a final topic, okay, I'm going to talk about statistical discrimination. Statistical discrimination in insurance markets. Okay, suppose that an insurance company knows that there are two different types of people with different expected losses. Like maybe men and women are different, and men expect to have a $4,000 loss. Women expect to have a $1,000 loss. Okay? I mean, we could be talking about car insurance, right? You young men, you know that you all are more dangerous drivers than the rest of the population, correct? Okay. I was once one of you all too, okay? And you know what happens to our car insurance premiums, right? We pay the highest rates, yeah, till you're 25 or so. Okay, young women, you all have lower costs. So that might be what I'm talking about here. But I could also be talking about health insurance. What if it's the case that women tend to have higher health care costs than men? How should the insurance company price its policies? It has a choice. It could either offer like just a single rate, $2,500 for all, regardless of gender, or it could discriminate Okay, discriminate means to treat different groups differently. I brought up price discrimination with monopolies. All discriminate means is to treat differently. Or it could discriminate and charge men $4,000 and women $1,000 for insurance. So there are these two alternative ways they could approach pricing, either just charge one rate for everyone, regardless of kind of their background risk, or alternatively tailor the cost of the premium to things that we know impact or can predict. Can predict the loss. In this case, gender helps predict the loss. Okay, let me say, charging a single rate is unprofitable. So again, charging a single rate is unprofitable. Just simply imagine I have one firm and I'm offering insurance to everyone at the cost of $2,500. That would work if I'm the only insurer in the market. I guess that would work, as long as the women are required to purchase insurance and the men. I could do it. But then if someone else opens up a competing insurance company and they offer different rates for men and women, and they say, hey, we're offering insurance for $1,000 to women, and it costs $5,000 for men, $4,000 for men, my competitor offers that, then all the women are going to leave my business. Again, I'm charging $2,500 to everyone, regardless of gender. All the women are going to leave my business and go to the company that does discriminate. And so I'm stuck insuring only men. Of course, they don't go to my competitor. My competitor charges men $4,000. So the men stay with me, and I'm stuck insuring these men who have $4,000 of loss, and I'm charging them only $2,500. That is unprofitable for me. I lose money by ignoring gender or ignoring anything that predicts the cost of insurance. A company that does discriminate will be more profitable, and a company that does not use that information will be unprofitable, right? Will actually lose money. Well, this leads into some other tricky things. I'm sure we've come to accept that car insurance companies charge different premiums simply based on age and gender. And it's not that they hate young men inherently, they just hate risky drivers, and young men statistically are the riskiest drivers. That's why it's called statistical discrimination, just discriminating based on your chance of being a dangerous driver. But what if we did that in health insurance markets? How would people feel if men and women are charged different health insurance rates? I am fairly certain that one gender costs more to insure than the other. I don't know which one it is, but I would be shocked if they cost exactly the same amount. So should insurance companies discriminate and charge different premiums based on things like gender? Okay, now gender discrimination is, I believe, illegal for health insurance. But then we get into other things, like what about other conditions a person might have that predict how expensive their health care would be? What if, instead of talking about men versus women, what if this is diabetics versus non-diabetics? And a diabetic person would need $4,000 of health care in a year, whereas a non-diabetic can anticipate about $1,000 of health care costs. Should an insurance company turn a blind eye to that information and charge the same premium to diabetic and non-diabetic customers? Well, what I'm getting at is this tricky issue of pre-existing conditions. Okay? Should an insurance company be able to turn away a person because of a pre-existing medical condition, or charge them a higher premium because of a pre-existing medical condition? Again, like being diabetic. Well, I would point out right here, from this example that I've done right here, it is unprofitable for a company to turn a blind eye to that information. If my company says, we're going to charge everyone the same insurance premium, health insurance premium, regardless of any pre-existing conditions you might have. If you're healthy, if you're diabetic, if you have heart problems, if you've just recovered from COVID, doesn't matter. Everyone gets charged the same premium out of fairness. My company's going to go out of business because a competitor will offer cheaper insurance to healthy people and refuse to insure the people with conditions. So then my company would be stuck providing insurance to only the people with pre-existing conditions, the most expensive people to insure. So if I try to turn a blind eye to pre-existing conditions, I will get stuck insuring only people with pre-existing conditions. And a competitor can steal away the healthy customers by offering a discount to healthy people or charging a higher rate to people with pre-existing conditions. So the whole discussion about pre-existing conditions is along the lines of should companies be allowed to discriminate against customers who have pre-existing conditions, medical conditions, that put them at higher risk of having expensive medical costs? And as a matter of fairness, I suppose the answer might be everyone should be charged the same premium. But as a matter of economics, that policy is unprofitable. Okay? That's a really tricky thing to get around. Like, how do we deal with these pre-existing conditions? And that's part of why it's been a contentious matter. And really, a simple thing to do might be to legislate that all insurance companies must ignore pre-existing conditions. And then my competitor would not be able to steal healthy patients or customers away from me. Anyhow, I think, at this point, I've talked about statistical discrimination. This shows up in all kinds of insurance markets, different costs for insurance based on age and gender, driving histories. In healthcare, the big important thing is pre-existing medical conditions. Okay. And having said that, I think I'm tired at this point. I've been talking for a really long time. You all are probably ready to go home. I will post that test on Thursday.